Is your Vanguard index fund part of a wider bubble which is about to burst? Well, as part of this month's Vanguard portfolio update, where I transparently share my very own Vanguard portfolio with its real life gains and losses, I wanted to delve into the very reasonable argument that index funds, like my very own FTSE ALL-WORLD UCITS ETF and other index funds on Vanguard, are in fact part of a bubble, meaning they are deeply overvalued and likely to come crashing down at any moment. And for me, this debate really does matter. I currently have around £75,000 in my Vanguard account, all in a single index fund, and I don't want to see its value half overnight due to some bubble. So let's jump into it. Well, it should come as no surprise that this argument is being primarily pushed by active fund managers, who are the ones that lose out to individuals choosing to invest passively. So there is potential motivation to cry wolf, but based on their argument, I think they might have a point. The premise of the index bubble argument falls into two simple points. The first is that index investing completely ignores price discovery, meaning buyers are ignorantly buying stocks of companies with little to no regard for valuation, theoretically meaning that overvalued companies would continue to be purchased. Thus, a bubble forms. The second is that this lack of price discovery has only been made significantly worse by an increase in passive investing over the last 20 years. Well, if you look at these two simple points, I would say they've got a pretty strong case. Index investing does completely ignore price discovery on several levels. The first, you're literally buying an index, so you can't avoid buying companies which are deemed overvalued, as they're simply all lumped together. And two, most index investors couldn't give a monkeys what price the index is at. Take me, for example. My current direct debit goes out on the 25th of every month, and it buys as many shares of VWRL that £940 lets me. So that could be 940 shares priced at £1, or just one share priced at £940 for all I care. But maybe I'm part of the problem. Their second argument doesn't seem that unreasonable. Even in my short investing career, I feel that index investing is as popular as it ever has been, and I can easily see how demand has increased over the last 5 years, never mind the last 20 years. But me saying it feels like a good argument isn't going to help us. So let's look at the raw data to understand how much merit this argument has and understand if we are truly lemmings all walking off a cliff together. Let's start with the demand for index funds. Back in 2002, just 2.5% of US equities were held within indexes. Well, if we skip forward 20 years, and this number is believed to be not too far off 30%, meaning a potential balance of one passive investor to 19 is now just 1 to 3. Which is a massive 6x. A hell of a change considering that 20 years in the investing industry isn't a long time. On top of this, data now goes further to show that at least one of the big three investment companies, so Vanguard, BlackRock and State Street, are one of the top 3 biggest shareholders in over 90% of S&P 500 companies. So index funds are at the forefront of ownership of the majority of the S&P 500. Okay, so from this information, I think we can all clearly agree that index funds are a significantly larger part of the investing world as opposed to 20 years ago. But just because it's a bigger part doesn't mean it's a problem. After all, the increase in demand is only an aggravating factor, not the cause. The fundamental problem with index fund investing is, and I quote Michael Burry here when he says,
passive investing has removed price discovery from the equity markets.
So people are blindly buying their beloved index funds, resulting in an over-allocation of capital to companies held within these indexes, which might not be good value, instead of buying other options outside of the indexes that might be good value. Well, there's actually an easy way to test this theory. Every so often, a company joins and leaves indexes for various reasons. Some go bust and others are relegated as other companies have grown faster than themselves. It's very much a real-world example of what happens in the Premier League each year. So based on the theory of an index bubble, companies which go from not being included in an index to being included in an index should see a significant increase in their valuations. So what has happened when a new company joins the S&P 500, for example? Well, there have been several papers published on this very topic. Maria Kask and Asani Sarkar looked into this and published a report across 55 pages which went into answering, is there an S&P 500 effect? Without taking you through all the funky details, like literally, what does that symbol even mean? This is what they had to say in their summary.
We find that firms included in the S&P 500 index are categorised by large increases in earnings, appreciation in market value, and positive price momentum in the period preceding the index inclusion. Our results indicate, after accounting for this firm's extraordinary pre-inclusion performance, index inclusion has no permanent effect on value and co-movement.
So once a new inclusion is announced, and remember, inclusion isn't instantaneous, there's normally a 1 to 2 month period before they actually join. After the time of the announcement, but before they actually join, the stock price tends to jump purely off this news. But once the inclusion actually happens, any boost the company's received quickly declines back down to its baseline. So being included in an index doesn't seem to have any long-term effect on the actual company. But this spike and eventual decline might be explained very easily. Let me introduce you to the Grossman Stiglups paradox. The paradox is straightforward. It states that markets cannot be perfectly efficient. If this was the case, then every single stock would be fair value, meaning there would be nothing to gain or lose by buying or selling, effectively making the market, so the act of trading stocks frequently, completely redundant. Based on this scenario, everybody would use index funds. But this is where the paradox comes in. If everyone buys index funds, then they can't react to new information. Say Amazon suddenly are making 10 times the profits out of complete nowhere. People wouldn't be able to take advantage of this, as they'd only be buying index funds. So to keep the markets efficient, there is a need to have individual pickers of stocks who are actually managing their portfolios by buying and selling individual companies to keep the markets efficient. So this cat and mouse game is essential to have an active and thriving stock market. And this explains the findings from the companies being included in the S&P 500. Active investors quickly sell the overvaluation of a company to make the markets more efficient. So if index buys are fundamentally inefficient, and when you think about it, we actually are, as we can't, or at least we won't react to new information, then surely this is actually an argument for index funds being bad for the market. So how much impact do index funds actually have? Well, index buyers might not be as dominant as you might think, even though they make up close to 30% of the stock market. And the asset managers who represent the index fund buyers have a sizable positions on 90% of the S&P 500 companies. You might be surprised to know that index investors only make up 5% of the trading volumes on the open stock market. You might scratch your head and think this has to be wrong. How can 30% of the market be held by index funds, but only 5% of the trading volume come from index fund investors? Well, the biggest part of this reason is powered by the secondary market. When you're buying your latest Vanguard ETF, you are either buying from the primary or secondary market. In around 98% of occasions, you'll be buying from the secondary market, meaning you're buying one share of, say, the global all cap from another person who is selling one share of their global all cap. This won't disrupt the flow of Apple shares, for example, actually being bought and sold on the primary market. In the remaining 2% of occasions, Vanguard might be forced to go to the primary markets, so creating a new share of the global all cap if there isn't enough sell demand, by buying small parts of the individual companies, forming a new share of this index fund. Just like they might have to go to the markets and sell a share of the global all cap, by effectively breaking down that one unit of the index fund into its smaller pieces and selling it on the primary market. So all in all, index funds buyers and sellers make up a very small part of the active traded market, which actually is the primary driver of price. So I've just thrown a lot of information at you with reasons for and against the idea of an index bubble. This is where I personally stand on the issue, and I'll probably have a little bit of a more balanced view than you might think. Do I think we are in some kind of index bubble? No, far from it. But do I think if too many people bought index funds, it could cause worse returns than active investors? Yes, potentially. Let me explain. The Grossman-Stiglups paradox teaches us an important lesson. You can't have passive investing without active investing. Otherwise, the markets wouldn't work. But equally, all the evidence we currently have shows that the effort required to make markets more efficient, so effectively managing to get a better return than the broader index, isn't worth its time or monetary investment. This was famously highlighted by Warren Buffett in 2008, where he issued a challenge to the hedge fund industry that they wouldn't be able to beat the S&P 500 over a 10-year period when they factor in their fees. A hedge fund named Protege Partners took the bet, and both parties put down a wager of $1 million each. But by 2015, so only 8 years into the 10-year period, Protege Partners admitted defeat, And this ties in with other findings from around the industry, with one paper showing that over the last 15-year period, roughly 92 to 95% of active fund managers cannot be the index, which is for me the reason why I'm a passive investor. Why try to beat the index with odds of 1 in 11 when I can do practically nothing and beat over 90% of active investors out there? But I'm not necessarily uber bullish on passive investing, and I do have a slightly pessimistic view in all this. And it's tied to the well-known fact that investors say that past performance is not an indicator of future performance. The 15-year period this research was carried over took place in an era where index investing was far smaller. Who's to say that the next 15 years isn't dominated by active fund managers beating passive benchmarks due to the significant increase in market inefficiencies caused by the large part of the market being made up of passive investors? Just maybe all my lazy monthly buying is causing market inefficiencies that active investors can take advantage of. No one can say for sure, but there has been some research to suggest that the market could be made up of 90% passive investors before the market became too inefficient. But I guess only time will tell. I would love to know your thoughts. So let's check in and see how much I could potentially lose if the stock market tanks then. How has my Vanguard portfolio done over the last month? Well, if this is your first Vanguard portfolio update, then all you need to know is 3 simple things. 1, I only invest into VWRL, which is the FTSE ALL-WORLD UCITS ETF. Yes, I also like the global all cap, but it's slightly more expensive. No, life strategy is too overexposed to the UK. And yes, I would prefer to invest in VWRP, but it isn't offered on the Vanguard platform. So I'll just save some of those questions to the comment section. 2, I started investing at the very start of 2018. So this is my 5th year of investing. And 3, lump sum investing is my jam. No dollar cost averaging, no buying the dip. As a reminder, at the end of last month, it was the first time VWRL had gone up in 2022, and I was really enjoying it. After investing a bonus from work, I'd moved my portfolio from £68,000 all the way to £76,000, with a bit of growth from the market. Well, this month didn't continue the new trend. After a month which was bogged down by negative headlines, VWRL has traded down by 3%, bringing us down from around about £90 down £3 to £87. This sell down has taken roughly £2,000 off the valuation of my portfolio, but I have made up some ground with this month's direct debit and also a chunk of dividends that came in the last 30 days. With all this said, meaning I'm only roughly down £1,000 versus last month. If we look at a chart view, it looks like my account has really flatlined since last month, as it's only changed by 1%. This change has meant that my new portfolio balance is £75,466 with profits of £15,295. To show the realities of investing, my current profits are the same as they were back in September 2021 and are actually £3,500 lower than they were in December 2021, meaning I've effectively lost money so far this year. So even though my total portfolio is over £10,000 higher than it was in September, I haven't made any more profit. So it just goes to show that the headline number doesn't give you the best reflection on performance. But by the same token, back in March 2020, at the very bottom of the COVID crash, I was actually in over £3,000 of a loss. But over the following 8 months, I was up nearly £7,000. I mean, I'd gained £10,000 profit in just 8 months. So there's no hiding behind the fact that my recent portfolio growth has been purely down to how much I've been able to invest. If you want to know more about how I make extra money to invest, then I highly recommend you check out this video here, as it shows you the best side hustles for people who are time poor. That's all for this video. See you in the next one.